In this video, I'm going to begin to discuss different equity valuation models and different ideas about valuing the equity of a firm. So we're going to start off with the description of intrinsic value versus the market price. The intrinsic value of a security or a stock is based on its expected future cash flows and those cash flows that are paid out to investors and the required rate of return on the security. And to get the intrinsic value, analysts will look at the financial statements of the firm and projections about the firm's cash flows and expected dividend payouts and expected stock repurchases to get an idea of the cash flows that will be paid out to the investor. And then they're going to also evaluate the required rate of return on those cash flows and for that firm to come to an intrinsic value. The market price of the stock is different than the intrinsic value in that it's the amount that we see. We can see the market price when we look up the quote for a stock. The difference between the intrinsic value and the market price is referred to as the degree of mispricing. And mispricing comes from two different areas. So there are two sources of mispricing. The first source is the difference between what the analyst estimate of the intrinsic value is and the actual intrinsic value. So we're going to call V the intrinsic value of the stock. And EV is the estimated intrinsic value of the stock. EV minus V is mispricing due to analyst error. Here we go. P is the market price of the stock. And again, that's what we can see. We can look that up and see what that price is by looking at a stock quote. And V again is the intrinsic value of the stock. P minus V is the other source of mispricing. And this is the degree to which the market doesn't recognize the fundamentals of the investment of that stock. So in the latter case, oftentimes what analysts are looking for is some kind of catalyst to encourage the market to look at the stock a little bit closer. An example of a common catalyst are earnings surprises. So whenever the company comes out and announces their quarterly earnings and the quarterly earnings are better than expected, that makes people stand up and recognize that there's something going on with the company that isn't currently included in the price of the company. And oftentimes what happens in that case is that the stock price will increase as a result of that earnings surprise. The opposite can happen too, where the earnings surprise is negative. In other words, the quarterly earnings for the firm are less than what's expected. And again, that's a catalyst for getting people to recognize that maybe things aren't going so well with the company and the stock price drops as a result. So a catalyst is often needed to correct this type of mispricing. A common catalyst is an earnings surprise. There are other kinds of catalysts out there. It could be something happens within the company or some big news announcement occurs. So, for example, Boeing in the past few years has had some problems with their planes. As that news hits the marketplace, the stock price changes. The problems have been ongoing, and the problems have been, within Boeing for quite a while, but the market is just finding out about them now and reassessing the value of the company in light of those problems that are coming to light now. The same thing happens with earnings announcements, and also sometimes with the annual reporting of their financial statements. Information will be released about the company where that information changes the market's perception and the price of the stock. We're going to talk about different valuation models, and the two I'm going to talk about in this video are the valuation by comparables, and then we're also going to get into dividend discount model evaluation. So, valuation of comparables, the idea here is that we take comparable firms and we evaluate the values of different firms together to maybe see why they might have different values. We use comparable equations because if we just took the stock price of one firm and the stock price of another firm and compared the stock prices, it wouldn't make a lot of sense. And I'm going to show you some examples of this. But there are three price multiples they're frequently used. Those price multiples are the price to earnings ratio. That's what I have down here. PE, price to earnings ratio, the price to book ratio, and the price to sales ratio. Let me just go through these and give you some definitions here. So PE is the price to earnings ratio and is calculated in different ways. I'm going to show you two different ways that we calculate it, but in general it's calculated as the price per share divided by the earnings per share. Price to book, P/B, is the price to book ratio and is calculated as the price per share divided by the book value of equity per share. And the book value of equity per share is just taking the value of equity on the financial statement on the balance sheet and dividing it by the number of shares outstanding. The price to book ratio is also commonly called the market to book ratio. However, there are some other definitions of market to book ratio. A lot of academics will calculate the market to book ratio as the market value of the firm's assets divided by the book value of the firm's assets. Finally, the price to sales ratio, that's P/S. This is the price to sales ratio and is calculated as the price per share divided by the sales or revenues per share. So the last one, the price to sales ratio, is often used in situations where you can't get much information about the company. I've particularly seen this one used fairly often when you have a privately held firm where you only have maybe the sales for the company, the amount of sales for the company, and you want to get an idea of how much the company is worth based on that. Outside of that, the price to sales ratio is challenging to use because you don't have a lot of information outside the sales of the firm in order to determine how much value the firm should have. The price to earnings ratio is more useful than the price to sales ratio in that it tells us how profitable the firm is, the earnings of the firm, rather than just how much they're selling. I'm going to go through a couple of examples of the price to earnings ratio and talk a little bit about the weaknesses of the price to earnings ratio and the price to book ratio, things that we can look for. The last item I have on here is enterprise value multiples. They're ratios of the total firm value divided by some measure of fundamental value, such as earnings before interest and taxes, sales, or operating cash flow. The idea with all of these comparables is that we're finding some measure that we can use that's comparable across firms. Okay, so earnings per share is comparable across firms. The book value of equity, in many cases, is comparable across firms. We can go outside of the different financial values like earnings and sales and book value to go for certain industries and get into things like the number of subscribers a company has. Okay? Think about social media companies. How many active users do they have? And we can assign a value to each of those users to then get an idea of how much a company would be worth based on the number of users that it has. So the method of comparables compares the price and enterprise value multiples of the subject firm with those of similar assets. Similar assets are referred to as the comparables, comps, guideline assets, or guideline companies. For example, we could compare the PE multiple of a firm with that of comparable firm, in terms of risk, profitability, and growth. The comps would be a similar firm or group of firms in the same industry. So if a firm had a higher PE than the comparables, it would be deemed to be overvalued. Note that this assumes that the comps themselves are correctly valued. The economic rationale for the method of comparables is the law of one price. And the law of one price says identical assets should sell for the same price after we account for moving that asset somewhere else if it needs to be moved. So, the idea is that you can't get a risk-free return by selling the same asset for two different prices. In other words, I can buy it at one price and I can sell it for a higher price. If that were guaranteed, I would get a risk-free return, which is referred to as pure arbitrage. The law of one price says that can't. That is not a situation that can persist because the market will step in and correctly price the assets so that risk-free return goes away. I should say risk-free excess return goes away. So I'm going to start off by talking a little bit about the rationales and drawbacks of the price-to-earnings ratios. The price-to-earnings ratio is a popular method to use to compare companies, and it's been around for a very long time because prior to 1987, publicly traded firms weren't required to provide anything except for a balance sheet and income statement to their investors. Beginning in 1987, firms had to start issuing the statement of cash flows along with the balance sheet and income statement. So with the balance sheet and income statement, we could calculate the price to earnings ratio and we could calculate the price to book ratio. The price to earnings ratio is a useful measure because earnings power is, and what I have here, earnings power as measured by the denominator earnings per share, is the primary driver of investment value. In the long run, in order for a firm to pay cash out to its investors, it has to have positive earnings. And the degree to which those earnings increase over time represents the ability of the firm to increase the cash payments out to investors over time. So earnings are tied to the ability of the firm to pay out cash to investors now or in the future. So a firm can have positive earnings and not pay that cash out. If they are reinvesting those earnings, though, it's going to increase their ability to pay out additional cash in the future, and that's what investors want. The PE is widely recognized and used by investors. And then finally, PE differences are significantly related to long-run stock returns according to empirical research. And what we know is that higher PEs generally lead to lower long-run average stock returns. So firms that have high PEs compared to other firms generally have lower long-run stock average returns compared to those other firms. That's not always the case, but it has been shown to be the case over most decades, with the exception of the decade from 2010 to 2020. During that decade, what we refer to as growth firms, and those are going to be the firms with the high PE ratios, tended to outperform. Outside of that decade, for the past 100 years or so, 90 to 100 years, over most decades, over most 10-year periods, what we refer to as value firms, those firms that have lower PE ratios, tended to outperform those that had higher PE ratios. So some potential drawbacks to the use of PE ratios include that the earnings can be very small, zero or negative relative to price, and any of those produce a price to earnings ratio without economic meaning. So a very small earnings per share value will result in a very high price to earnings ratio. Sorry. A very small earnings per share will result in a very high, and I'll put in here, inflated price to earnings ratio, because the denominator in that case is very, very small relative to probably a normal price for a stock. A value of 0 for earnings per share would result in, we take a price divided by 0, it's undefined. And since prices of stocks are always positive, you can't have a negative stock price. If you have a negative earnings per share, that means your price to earnings ratio will end up being negative, which doesn't provide a lot of information to the investor other than you had a negative earnings for the firm. The second potential drawback, is the transitory portion of earnings can be difficult to distinguish from the permanent component that is most important for valuation. And what this means is that some earnings for firms are non-recurring. So if a company sells off a portion of its business, they can't resell that off. If a firm has a lawsuit, they win a lawsuit, that's a one-time thing, that's going to be non-recurring. Or if they lose a lawsuit, that's hopefully non-recurring. And so adjusting for non-recurring items is important when calculating price to earnings ratios. And sometimes it can be difficult to determine what portion of earnings is transitory, in other words, one time or won't occur for very long, relative to the portion of the earnings that is permanent. Finally, managers have discretion in determining reported earnings, although this has gone down in the past few decades. Some managers still have some discretion in when things get shipped, when products get shipped, when sales are recognized, and when earnings are recognized. And so that can lessen the comparability of PEs across firms. Limitations to book value. So I talked about price to book value. Book values are usually based on historic cost, not current value. This is important to remember because if you're comparing two firms of different ages, especially if they have a lot of real estate on their books, if that real estate is recorded on the historic cost, not the current value, then the value of the assets and as a result the value of the equity can be understated for the company. So firms that are older may have their book values understated when compared to younger firms. And holding all else equal, the price to book value then for those older firms would be higher than those of younger firms because the book values would be lower. The next limitation on book value is that the floor of a firm's stock price is not the book value of its equity, which is kind of what we would, maybe assume, but rather based on its liquidation value. So the minimum value of a company is not the amount of book equity it has on its books or the value of assets on its book, but really it's the liquidation value. What could you get for the company in liquidation? The liquidation value of equity would be the liquidation value of the assets minus the value of liabilities on the books, because those would have to get paid first, and then you would have a remaining, hopefully, some remaining equity left over in liquidation. The next limitation on book value, and this has become a big one in recent years, the book value of equity may be negative if the firm has repurchased much stock. And so we're beginning to see this a lot, especially after we've had a few decades, about 3 decades of a lot of large firms actively repurchasing stock. They have negative book values of equity, which isn't really a negative thing, a bad thing, because they've, essentially used their cash to repurchase shares of stock and reduce the equity value that they have on the books. And so it doesn't point to, danger for the firm whenever they have that negative equity. It's just a result of accounting practices. So in those cases, the price to book value isn't very useful. It's not a useful number to look at. Let me pull up an example of that. So here's McDonald's. I'm going to pull up their balance sheet. So we can see here the total common equity for the firm, and so this is where we would get the book value of equity, and we would divide this up by the number of shares to get the book value per share. And you can see here the total equity is negative across the board, and McDonald's is a fairly healthy company, but the reason why they have negative book value of equity is because they've repurchased a lot of stock over the years. And they use the treasury stock method, which is a contra equity account, and so as a result, the book value of equity is negative for the firm, and so that price to book ratio would not be a useful number when looking at McDonald's. Finally, the replacement cost of assets minus liabilities is also a measure of firm value. And I mentioned before the liquidation value. The replacement cost is another way that we can value a firm. If we took the assets of the firm and figured out how much it would cost to replace them today, this is another method of considering the value of the assets of the firm compared to their historic cost. So based on Tobin's Q, or Tobin's Q ratio, if the market value of the firm is higher than its replacement cost, then competitors will enter the market to drive down the value. If the replacement cost is less than the market value, then management has destroyed wealth. The idea, again, of the replacement cost is that the firm can use its assets in a way that increases their value. And so what we want to compare, according to Tobin, is how much are the assets of the firm worth in the marketplace compared to how much are they worth to investors. And if they're worth more to investors as part of the company than they would be if we just sold them out in the marketplace, then management has created value there. And so those are some limitations on book value and some alternate ways to describe or ascribe value to the assets or the operations of the firm. I'm going to dig in now to the price to earnings multiple definitions, and I've got a short spreadsheet that I'm also going to use here. So when calculating the price to earnings multiple, the stock price numerator is unambiguous for publicly traded firms. We can look up the number, okay? It's not something we have to guess at. We know what the stock price of McDonald's is today. The earnings denominator, however, can be generally characterized in two different ways: the time horizon over which it was measured and the adjustments to accounting earnings required so that PEs are comparable across firms. I'm going to focus primarily on the first one here, the time horizon over which it was measured. So the time horizon for earnings results in two broad definitions of PE: the trailing PE, which is also referred to as the current PE, which uses the past 4 quarters of earnings, referred to as the trailing 12 months, or TTM, earnings per share. The forward PE is also referred to as the leading or prospective PE, which uses next year's expected earnings, and those are usually based on analyst estimates or database estimates or estimates provided by the company. So I'm going to go out here and pull up a spreadsheet. And this spreadsheet has information on 3 fairly comparable companies. These are railroad companies in the United States. The first one is the CSX Corporation. The second is Union Pacific Corporation. And the last is Norfolk Southern Corporation. And they all ship goods using railroads. That's what the companies are. So they're fairly comparable in what they do. You can notice the prices, though. The stock prices are very different. And this is primarily just a function of the number of shares each of these firms has outstanding. So you can see Union Pacific and Norfolk Southern, their stock prices are fairly close, but CSX Corporation is has a much lower value than the other two in terms of stock price. That doesn't mean the company's worth less. So what I've got here is that I'm looking up the price as of the financial statement date, and that's also the date I'm getting the information for the earnings per share and the past earnings per share. This was for the earnings per share for 2023, and the A stands for actual. And then the 2024 earnings per share, and the E stands for expected. So, the 2024 one, at the time I'm making this video, is a projected earnings per share for the year 2024. So we're going to calculate the trailing PE and the forward PE for each of these firms. So the trailing PE is going to be equal to the price per share divided by the earnings per share that have already occurred. And this won't be a dollar amount, it's just a ratio. And I'm just going to pull this down, and we can compare the trailing PE across the firms. So we see here that the trailing PE for CSX is 22.85, for Union Pacific is 29.31, and for Norfolk Southern is 24.83. Now, CSX does have the lowest trailing PE, but it's not because the stock price is lower, because it would be much lower in that case. The main difference in the stock price, again, is the number of shares outstanding compared to the overall earnings of the firm. You can see here that CSX has a slightly lower PE than Norfolk Southern and a little bit more a lower one than Union Pacific. It could be that Union Pacific is overvalued, so it may be one you want to avoid if you're considering these, or it may be that there's something different in the businesses of these three different corporations. Sometimes it's a difference in capital structure. In the railroad industry, the different railroads, in this case, generally have their territory over different parts of the country. And so it could be that Union Pacific right now has a more attractive territory that they cover than CSX. Now we're going to look at the forward PE, and then I'm going to describe in what cases we would want to use the forward PE relative to the trailing PE. So in this case, I'm going to take the price, and I'm going to divide it by the 2024 earnings per share. And again, this is a ratio, so I'm going to get rid of that dollar sign. I'll pull that down. We see that, the same trend we saw before, although the differences here are a little bit less. So the forward PE for CSX is 17.5, for Union Pacific is 21.95, and for Norfolk Southern it is 19.57. In general, if the earnings per share for a firm is expected to increase from one year to the next, and that's generally the case, then the forward PE will be less than the trailing PE. And this is why we want to make sure that when we're comparing companies, we're comparing the price to earnings ratios have been calculated in the same way. Otherwise, if we were comparing the trailing PE for CSX to the forward PE of Union Pacific and Norfolk Southern, we would say that CSX has the highest PE ratio, when in fact it doesn't. It has the lowest PE ratio of these three firms. So a few things to consider here. I mentioned before that a higher price to earnings ratio historically has resulted in lower long-run stock returns. Another way to look at PE ratios is that they represent what investors' expectations are for the firm. And the higher the PE ratio, that means the more that investors are paying for every dollar of earnings that the company is currently generating or is expected to generate in the next year, depending on how you're calculating that. So the higher the PE ratio, the higher the expectations that investors have about that company going forward. So of these three companies, investors have the highest expectations for Union Pacific, the second highest expectations for Norfolk Southern, and the third highest expectations from CSX Corp. I'm going to go back to the notes here just to finish up a little bit about these price to earnings ratios. Why would we use the trailing versus the forward, or the forward versus the trailing? Well, so the forward PE ratio is preferred over the trailing PE when trailing earnings are not representative of the firm's future. We've had some rocky years. In 2020 and 2021, we had COVID, and the results of that on many firms were very low earnings per share. And so they would have had very high price to earnings ratios because their earnings per share were low, especially the trailing PEs. And so in those cases where we feel that the earnings per share for a time period, or for a past time period, may not be representative of the future, we'd want to go ahead and use the forward PE, where we're looking at the expected earnings per share into the future. On the other hand, especially for very small companies that don't have many analysts following them, and so they may not have a very good estimate for their future earnings per share over the next year, in those cases, we'd want to use the trailing PE as our unit of measure, because there may not be a very good estimate for what the earnings per share for the firm is going forward. In the case of our railroads, these are all very large companies, And so as a result, the forward PE is a relevant and useful measure to look at. Finally, if earnings are zero or negative, the analyst may use a longer-term or future positive earnings figure. Regardless, the analyst should use the same definition of earnings when making comparisons across firms. So that, for now, that's where we're going to stop with the comparables. We're going to get more into this when we talk about dividend discount models, and we can use that price earnings ratio for calculating the horizon or the terminal value of a stock sometime in the future. Now I'm going to talk about the present value of growth opportunities. When we think of a firm's value, we can divide that firm's value up between the value of what the company is doing today and what the company may be able to do in the future, or its growth opportunities. What I've got here in the notes, it says the value of a firm may be thought of as the value of the firm without earnings or reinvestment, plus the firm's present value of growth opportunities, also known as the value of growth. Consider a firm with a 10% required return on equity. If the firm has new projects available with returns of greater than 10%, the firm should invest in them because they will generate positive NPVs, or net present values. If, on the other hand, a project's return is less than 10%, the firm should pay out all earnings as dividends. And in this hypothetical situation, the firm doesn't have any debt. It's entirely funded with equity. So, it says here, in the latter case, the firm should pay out all earnings as dividends, and earnings will be constant in perpetuity because the firm does not reinvest in operations. Firms in this position are referred to as no-growth companies. The no-growth value per share is valued as a perpetuity of E, so earnings per share, divided by RS. So with a no-growth firm, the firm is maintaining its ability to produce goods and services. It doesn't mean they've stopped investing entirely in their assets. But they're, let's say you've got a company that has a store. Okay. So a no-growth situation would be a store, would be that the company just maintains that store. It keeps it running. So every year it's going to have some capital expenditures probably, to keep the roof in a good condition, to keep the parking lot in a good condition, and so on. But it's not going to build an additional store. It's not going to add features to the store that would generate higher levels of revenue or higher unit sales from one year to the next. All they're doing is maintaining the current level of earnings and sales for that store. And that is a no-growth situation. Okay? So the company's not increasing its earnings, it's just maintaining what it has. So E doesn't have a subscript here because it's the same for every year. If, however, the firm does have positive NPV projects, and we were to discount those future cash flows, we would arrive at the present value of growth opportunities. In the formula below, if we assume that price is equal to value, then we arrive at a calculation for the present value of growth opportunities. Essentially, we assume the market stock price reflects a no-growth value for a firm plus the present value of growth opportunities. Firms with greater opportunities and those that have greater flexibility to modify projects through time, and those referred to as real options, will have greater present value of growth opportunities. The latter value arises because real options allow firms to respond to changes in the marketplace. We haven't talked about real options very much, but real options provide opportunities for firms to take actions in the future. If you think of a real option like a stock option for a firm, a stock option gives the investor the ability, if I buy a call option, I have the ability to exercise that option in the future and purchase a share of stock at a lower price than what it's selling for in the marketplace. A real option provides an opportunity for a firm to take an action in the future if they would not have the ability to do if they had not invested in that real option today. So several years ago, Walmart opened a store in China. And the store didn't do well, and there was a documentary about it. And in fact, in the documentary, the management of a manager from Walmart said, "We knew this store was not going to do well. We knew this store was going to lose money. However, putting a store in China gave us an option to expand there in the future." Okay? The store didn't do well because Walmart culture did not mesh well with the Chinese culture. And they learned some hard lessons, things like, where they put the store at. Most people rode bikes. People aren't going into Walmart and buying a 64-ounce jug of laundry detergent if they have to put it on their bike to get it home. And so out of that situation came came work with Walmart with their suppliers to make single-use laundry detergent packages. At the time that Walmart put this store in, they had what was referred to as the 10-foot rule. 10-foot rule meant that if a customer was within 10 feet of a Walmart associate, the Walmart associate is supposed to ask them, "How may I help you today?" Well, the Chinese consumers didn't like that. They kind of wanted to be left alone and not they didn't like that level of interaction. And so that's something that Walmart had to learn about its culture and about how the products they put in their stores to make it so that Walmart stores would be possibly profitable in the future in China. But that's an example of a real option. Firms that have real options have higher present value of growth opportunities. And we're going to take a look at some examples of calculating the present value of growth opportunities. So what I've got down here is when the required rate return on equity for a firm, is equal to its required rate of return on equity, then the present value of growth opportunities is equal to 0. When the ROE of the firm is greater, and it should be than, the cost of equity, then the present value of growth opportunities is greater than 0. And then I say down here, what are some examples of firms whose values rely heavily on PVGO? So I'm going to open up the workbook that we were on, and you can see the second tab here says PVGO. And I've got several companies here, and I'll show you how I calculate this. But we've got the beta for the firm. We've got the risk-free rate, and that's the same for all firms because it's the 10-year constant maturity rate. And essentially, it's the rate currently on 10-year Treasury notes. We have the equity risk premium, and this is the required rate of return of the average stock over the risk-free rate. And so we can, using the security market line, we can calculate the cost of equity. So the cost of equity is equal to the risk-free rate plus the beta of the firm multiplied by the equity risk premium. And this isn't always the best way to estimate the cost of equity for a firm, but it's a consistent way that we can use and we can look at across firms. This approach to calculating the cost of equity, or R sub S, takes into account the risk-free rate and also takes into account the sensitivity of the firm's returns to market fluctuations. We can see here that the required rate of return for Tesla, for their stock, is estimated at 15.43%, and we compare that to much more stable companies like Walmart at 6.47% and Evergy at 6.81%. If you're not familiar, Evergy is an electric utility. Other ones that you might be familiar with are Coca-Cola. Again, a low cost of equity, a fairly safe company, very stable revenues, very stable earnings. Macy's is a company that's not doing so hot, and we're gonna see that in here too. They are an old brick and mortar retail clothing store, primarily clothing, which has not done well in recent years. That industry just hasn't done well. Union Pacific, we talked about Union Pacific earlier. They are a transportation company, primarily railroad company. And so we can see here the different costs of equity for these different companies. Now we're going to calculate the present value of growth opportunities. And I'm just going to show you again how that's calculated. To get the present value of growth opportunities, we take the price of the stock minus the expected earnings for the next year divided by the required rate of return for equity. So that's what I'm going to do here. I'm going to take and make this equal to the price of the stock minus, and then in parentheses I'm going to take the expected earnings per share for 2024 and divide that by the required rate of return or the cost of equity for that firm, and then close the parentheses there. So we get the present value of growth opportunities for Tesla at 155.84, and then I want to see what are the present value of growth opportunities as a percentage of the overall price of the stock right now. So I'm going to take the PVGO and divide that by the price, and I get 88.94% here, and so I'm just going to make this into a percentage. I'm going to grab both of these and drag them down. So we can see here, I mentioned Macy's, they've had a hard time. Based on the present value of growth opportunities being negative, it's not a big negative number, okay? It's $1.71, and that negative number may be that the cost of equity could be a little bit off, or it may indicate that the expectation is that Macy's will continue to decline in the future, which would result in a negative value for present value of growth opportunities. If this were a no-growth firm, in other words, their earnings per share is expected to stay the same in perpetuity, then the PVGO would just be equal to 0. So this indicates maybe a little bit of a decline. Evergy, we see the same negative number here. Again, not a high percentage of its value, so it could be kind of a no-growth company expectation there, or investors believe, based on its price, that it may be in a little bit of decline. The companies with very high present value of growth opportunities are companies in which the investors are assigning a high value to the future expectations of the company rather than the value associated with the current operations of the company. And so this is definitely true for Tesla. The investors in Tesla right now are not basing the price of the stock on what the company is currently selling and the earnings that they're currently generating, but on the expectations of future growth. If we take a look at the other one that's fairly high here, NVIDIA. NVIDIA at this time has recently come out with forecasts that show a high demand for their chips that they make and used in AI applications. The more moderate ones we see here are ones like Coca-Cola, Union Pacific, McDonald's, and Walmart. So they get, roughly half or maybe a little bit more than half of their value based on what they're generating today, and maybe a little less than half their value, 40 to 50%, based on the future expectations for growth. I'm going to come back to that idea in just a minute. Let me go ahead and I will highlight these because these are the cells that we generated the values for. I'm going to go back to the notes now. So, what are some examples of firms whose values rely heavily on present value of growth operations? I showed you a couple there, Tesla and NVIDIA. What are some examples of firms who don't rely heavily on PVGO? So definitely Macy's, definitely Evergy, although those are not necessarily companies you want to invest in as a result of that. The other ones were companies like McDonald's and Coca-Cola, where some of their value does come from future expectations, but a lot of their value is based on the current operations of the firm. The idea of investing in firms that have high present value of growth opportunities, like Tesla, like NVIDIA, is referred to as thesis investing. So for these firms, investing in these firms is really about investing in an idea rather than on the current operations of the firm. And thesis investing is seen as a riskier approach to investing than investing in a firm's current operations. So that ends the discussion on the present value of growth opportunities. Now we're going to talk a little bit about dividend discount models. Dividend discount models were really the one of the first methods that investors used to evaluate the price of a stock and what it should cost in the marketplace. The reason why it's one of the first methods is that way back at the beginning of the stock market, almost all firms traded on U.S. stock markets paid dividends. It was an expectation that if your firm was listed on the New York Stock Exchange, that it was a stable company and that it paid dividends. As time has gone on, that's not necessarily the case for a few reasons. Nowadays, firms will have their initial public offerings and get listed on an exchange earlier on in their life cycle than they would back then. And also, there are alternatives to paying out dividends, such as through stock repurchases, that firms didn't have back then. But the idea behind a dividend discount model is that we're valuing the stock of a company based on the cash flows that we as investors are receiving or expect to receive in the future. When we compare valuing equity to debt, valuing equity is more difficult because if we're looking at bonds for a firm, we have all the information we need. We know what the cash flows are when we value a bond. We know that the bond's payments are the coupon payment and the par value at maturity. We know when maturity is, and we can actually look up the required rate of return for that bond. And so it's fairly easy to calculate the value of a bond. We don't have most of that information for a stock. We don't know what the cash flows are going to be in the future. We can estimate what dividends are going to be, but there's no maturity date for a stock, and so there's no end date at which we get a lump sum of money. We have to estimate the required rate of return on equity because it's not something we can just look up. We have to estimate what investors are requiring as their return for that stock. So in the dividend discount model, the dividends are the relevant cash flows. The rationale behind the DDM is that cash flows are the cash flows equity investors will receive in the future. And then I make a note here, however, that some firms do not pay dividends and other firms reinvest a substantial portion of earnings back into the firm. The argument for using the dividend discount model is that sooner or later all firms will pay dividends and reinvestment in the firm will increase future dividends. The choice of the discounted cash flow model for valuation should be based on the subject term's characteristics and the valuation perspective. And we're going to be going through a few different cash flow models, and I'm going to be talking for each one when it's appropriate to use it and when it's not appropriate to use it. So the dividend discount model is most appropriate when the firm has a history of dividend payments. This provides the analyst with a history from which to extrapolate future dividends. Otherwise, it's difficult to forecast when a non-dividend paying firm will start paying dividends and how much those dividends will eventually be. So back in around 2010 and 2011, it was kind of a surprise when Apple started paying a dividend. Apple had been around for several years. However, as long as Steve Jobs was alive, he did not want Apple paying a dividend. He wanted to see the cash flows generated by Apple reinvested back into the firm. Okay. After he died, though, and not long after he died, Apple started paying a dividend because they recognized that they were accumulating a lot of cash, and that investors didn't want them just to sit on a whole bunch of cash. They wanted those cash flows back. They wanted to start receiving dividends. And so, the catalyst that caused Apple, in my opinion, to start paying dividends was the death of Steve Jobs. And at that point, we could start using the dividend discount model to value that company. The second point I have here is that the firm's dividends have a consistent relationship with firm's earnings. And so that's what we want to see if we're going to use the dividend discount models. We want to see that as earnings rise over long periods of time, the dividends also follow suit. Dividends should be related to firm's earnings if they are to be a good indicator of the future firm and shareholder wealth. The third point here, the valuation perspective is that of a non-controlling shareholder. If the perspective is that of a controlling shareholder where the firm cash flow can be controlled, a free cash flow model would be more appropriate. And we're going to dig into that later on. But the idea here is that if you have a shareholder who owns a large portion of the firm's stock, they could, if this model is being used, they could automatically increase the value of the company by just increasing the dividends per share. Increasing the dividends per share doesn't automatically increase the value of a company, especially if dividends are being paid out instead of being reinvested into good projects. The dividend discount model, or DDM, is a basic tool in valuing stock. It is widely used and accepted among practitioners and academics. The DDM is based on the idea that the value of an investment is the present value of its future cash flows. And I apologize. It should say where the future cash flows are the dividends. There we go. And then I've got an equation down here. We're going to work through this in Excel. This equation is useful though. So it says the value of the stock today is equal to the future dividends. And you see here we have P. So this is the price or the value at the horizon period. And I'll explain what that is. And this is equal to the sum of all the future dividends to time T, for time T, through time H, and then at time H, or the horizon period, we determine what the value of the stock is using what's referred to as the constant growth model. And we're going to discount all of those cash flows back to today at the required rate of return for equity. So the formula says that the value of the common stock at time 0 is V sub 0 is equal to the discounted stream of future dividends plus the expected price of the stock when sold at time period H. The discounted cash flow, the discount rate is the required return on common equity, RSI. The formula assumes that the stock will be held for H periods. Note that the notation term H is used instead of T or N or anything else because it stands for horizon value, and we'll come back to that idea later. We're going to start off with a very basic model called the constant growth model. The constant growth model says that the value today is equal to the last annual dividend paid multiplied by 1 plus the growth rate. And the idea behind that is we're getting the next dividend, the next annual dividend, and we divide that by the required rate of return on equity minus the growth rate. And I often like to put some parentheses in here just to remind you to put those parentheses in your equation when you're using Excel. So the formula assumes the following: that the required rate of return on equity is greater than the constant growth rate, and that G is constant. So I've got an example here where we have the following information. The risk-free rate is 3%, the equity risk premium is 6%, the beta for the firm is 1.2, the current dividend is $2, so that's D sub 0. The dividend growth rate is G, and that's 5%. And the current stock price is $24. And that's not terribly important for what we're doing here, except for to compare the price today to the value today. So we're going to start off by calculating the R sub S, so the required rate of return on equity for the stock. We're going to use the security market line from the capital asset pricing model to determine this. So R sub S is equal to the risk-free rate plus the beta for the firm multiplied by the equity risk premium. And again, just as a little reminder, we multiply the beta by the equity risk premium, and we add that to the risk-free rate. And so in this case, and I'll go out here to Excel to show you this. I'm going to open up a new tab, and I'm going to name this DDM for dividend discount model. And our example here, we have the risk-free rate, we have the beta, and then we have the equity risk premium. So the risk-free rate again is 3%, 0.03. The beta is 1.2. And the equity risk premium is 6%. Sometimes I see people subtract the risk-free rate from the equity risk premium. You don't want to do that because the equity risk premium is the return on the average stock in excess of the risk-free rate. So that risk-free rate's already been taken care of in that calculation. So our cost of equity, or our R sub F, is equal to the risk-free rate plus the beta multiplied by the equity risk premium, and that gives us a value of 10.20%. Our last dividend paid, and this is our annual dividend amount. When we start to work with real companies, we sometimes will get quarterly amounts, and we want to annualize those. And our last dividend pay is D sub 0. Our growth rate, in this case is a constant growth rate, was 5%. So our D sub 0 is $2 and our growth rate is 5%. So the price of our stock today, or the value of our stock today, so again, this is the intrinsic value. It's based on the expected dividends and the required rates of return. And it's going to be equal to, in the numerator, $2 multiplied by 1 plus the growth rate. And then we're going to divide that by, and you want to put this in parentheses, the cost of equity minus the growth rate of 5%. And so we get a value today of $40.38. And I put on there, the price today is $24. So if I found this out as an investor, if I'm looking at this company and I feel pretty secure about my calculations here, then I would want to go out and buy this stock because it's worth more. The intrinsic value is more than the price today. And even if I don't plan on selling this stock, or even if the value of the stock doesn't change, doesn't increase to that $40.38, I'll still come out ahead as long as I hold on to the stock, because the value of those dividends, just kind of back to today at my required rate of return, is much higher than the price of that stock today. So let's go back to the notes here. And so that's how you calculate the value here. So the current value of this stock, the intrinsic value, V sub 0, is equal to $40.38. So the constant growth model implies that a stock's value will be greater the larger its expected dividend per share. So the higher that D sub 0 or higher D sub 1, the lower the required rate of return for equity, the higher the growth rate of dividends. And for the rate of price appreciation, and I apologize, that is the three items there are the implications. The last item I have in here, the rate of price appreciation in any year will equal the constant growth rate G if the company is a constant growth company. And so what I have here, it says if the intrinsic value of the firm is equal to the price today, then the expected required rate of return on equity is equal to the dividend yield plus the capital gains yield. The dividend yield is the next annual dividend expected to be paid divided by the change in the price divided by the price of today. And that's a good stopping place for this this video. We will get into next time the life cycle and multi-stage growth models, where we don't assume that the dividends are constantly growing at a constant rate. Please let me know if you have any questions.